Hello, everyone. Welcome to the stock specific class here for Thursday, January the 5th. As always, if you have any questions during the week or any questions that I don't get to here in the live class, or if you're reviewing the recording of the class, you've got questions, make sure you send those to Jerry at TradersPro.com. I'll be happy to answer those for you. As far as the direction alerts, not much has changed from Tuesday, although we've got some pretty important events coming up that could be triggers for the next move in the market. Tomorrow is going to be a big day. That jobs report comes out. Remember, the jobs report comes out the first Friday of every month. There are times when the market doesn't really react much to the jobs report. And there are times when the market really focuses on it, just like with any government report or a Fed event, things like that. Sometimes the market is very intensely looking at what the number is going to be. Other times, the market already kind of knows what it's going to show it, and so it doesn't react that strongly to whatever comes out. But with the market being sideways here for the last couple of weeks, that sideways movement reflects indecision. It reflects the traders waiting around for something. And so whenever you see that, you start to look out and say, okay, what could be a possible trigger that starts movement again, whether that movement's up or down. That's the first one that comes to mind is this Friday's jobs report, tomorrow's jobs report. It'll come out tomorrow morning. There's also Chairman Powell's going to have a speech next Tuesday that could be important. Just from the standpoint, there's no Fed meeting in January. The next Fed meeting is actually, I believe, February 1st, the first day of February. And so, these traders want to be able to analyze Chairman Powell, what he's wearing, and did he blink 3 times when he said a certain word? And so they'll probably be watching that speech and could react somehow to that, what goes on there. The other important event, we've got earnings starting to kick in this month. It'll be probably next Friday that the bank stocks start report earnings. They're the ones that usually kick off earnings season. That'll provide some news for the market to react to. And then you've got the CPI report coming out January the 12th, which will be next Thursday, right? Yeah, next Thursday. Definitely could be a mover or a trigger. Now, again, I don't get too caught up in trying to figure out what those events are going to mean and what they're going to say and how the market is the market going to like what they say or not like what they say. The easiest thing to do is just be a technical trader, look at the charts, learn how to read price action, learn how to read the charts. It'll save you a lot of time and just all we care about is what directions the market go in. Now, we're going to analyze today before we get into specific stocks to look at. We want to get a gauge as to what are the conditions we're in. Are we in conditions where the market is more likely to go up? Is it conditions where the market is more likely to go down? Are we in a condition where the market is moving sideways and is neutral? These are important things to decide or to determine before you make a trading decision, because getting the market direction right is very important. There are stocks that go up when the market goes down and stocks that go down when the market goes up. But you're usually going against the current, so to speak, when you're trying to do that. It's like swimming upstream in a river. Can you do it? Yeah, you can do it, but you use a lot of energy and you don't go very fast. And the minute you slow down, you get sucked right back into the direction of the river. So the easiest thing to do is try to find out what the direction of the river is, and as much as possible, try to go that direction. Now, this first section here with the direction alerts, what we're analyzing here is just extremes. Are we overbought or oversold? Has the rubber band been stretched too far to one side? Have we gone up too far too fast and we might snap back down? Have we gone down too far too fast? We might snap back up. That's really the main purpose of these direction alerts. And when they're not telling us an extreme, we don't want to. That's all we care about. We don't want to read too much into what these indicators are telling us. If they're telling us that there's no extreme, then we're assuming that whatever the trend is, the current trend of the market is, that's what we want to follow. And that's why the next phase is we'll get to looking at the charts and get an idea of what the charts are telling us as far as trend direction. We are in a bear market, and we are in an extreme bear market as far as being all the way to the far left side of that. We've been in a bear market for a long time. These long-term signals don't change very often. So when they do, it is significant. If we reverse back from a bear market into a bull market, that doesn't happen very often. It's definitely something we want to pay attention to. It's also important to point out, though, that although we're at an extreme, we're at the far left side of the indicator here. It doesn't necessarily mean that we're at a market bottom. There is some scenarios where the market could go even significantly lower from here, possibly. And, I've shared with you some of the reasons why I think that we haven't had a panic sell-off yet. That typically has been part of every major market bottom that I've experienced in my trading career. But it's also worth noting that when we were in a bull market, we were at the far right side of this bull market, and we were stuck there for over a year, where we were in that extreme overbought area on that bull market. So just be aware with these longer term indicators. You see this, don't immediately assume that the market's it's at the far extreme of a bear market, so it's got to start going right back up. There is still some room for it to drop. Now, obviously, we can't know exactly when a bottom takes place. But like I said, when you get into this area here, you can start to look for some of the characteristics, and that's my job, is to kind of teach you some of the characteristics that often accompany a market bottom. What are some of the signals that might indicate that things are starting to head in the right direction? A couple of headwinds that I can talk about right off the bat that I've mentioned in previous updates. One thing is that the market has never bottomed before a recession has taken place, and there is a very, very high probability we're going to see a recession next year. I can't see how we will avoid it. Again, that's the probability. Now, there's always a possibility that we'll have a soft landing and Chairman Powell will pull us out of this without any sort of pain. Those are the types of things I dream about at night. All the nice things that can happen in life, and then I wake up to the reality of what we always have to deal with in the real world. But I have to go on the fact that these things usually don't end smoothly, and if we haven't yet, if we're not yet in a recession, that means the market hasn't yet bottomed yet, and that kind of again makes me assume that there's still a little bit more downside, a little bit more pain before we get done with this. Now, on the other hand, it doesn't necessarily mean that the market can't rally until the economy starts getting better. A lot of times, when we are at the worst parts of a recession, the market has already bottomed and started to move back up. So economic conditions could continue to deteriorate, and yet the stock market could start to rally ahead of it. Because the market's always forward-looking; it's always looking ahead. And so when you're analyzing the market, you don't want to think about what's happening right now. You're trying to think of what is happening 6 months from now. So that's part of what I think the issue is with one of the reasons why I think the market is not looking at reality yet, because I see 6 months from now recession either starting or being in the middle of one. It might be a brief one, I don't know, but I see 6 months from now that type of economic scenario. The market is telling us it's not seeing that, at least not yet, the way it's behaving, and it's not factoring that in. Now, maybe the market's right, and we never do get into recession. But like I said, when I try as much as possible to be on the right side of the probabilities and just try to analyze the probabilities, try to take the emotion out of it, or I'm not trying to predict anything or be psychic or anything. Just try to see the reality as best I can, and that's what I see. So we'll see what happens. Now, the rest of the alerts, momentum again, just right in the middle. Excuse me. This is just basically saying there's no extreme. I mean, we're almost in a sell area right here, but mostly we're in the middle. You're in the middle part right here. It just basically means the market is still trending. Whatever direction it's trending in, it should continue to trend in that direction. Breadth, same thing. And sentiment, obviously, has been an extreme overbought area for a long time, but that's another concern, is that we've had some of these sell-offs that has not brought any sort of fear in the market, any sort of fear in the selling yet, and I think that needs to happen, and it needs to happen in order to have a strong rally. The reason why people are afraid to buy is that they're afraid of the obviously the uncertainty of the future right now, but they're also afraid that the prices haven't come down far enough, and they don't want to be buying and then have it go down further. And so when you get a big sell-off where it comes down, a lot of times that freaks out the people that were already bullish or already thinking the market is bottom. They're the panic sellers. But then you get the professional traders where things come down and they're like, okay, this is a better area. This is a better reward risk where I could get in. And you could look at Apple for an example. Apple's come way, way down. Well, how come Apple's not shooting right back up again? Well, because traders are a little bit concerned that there's still more downside on Apple. And it, at some point, Apple will get to a level where they feel confident to buy into, and that's when when the prices get down low enough, it'll attract those new buyers to come in. All right, so that 7-minute indicator is something that we focused on. We're going to continue to pay attention to, because it's one of the main reasons why I think that we still have some ugly selling to come. That sentiment is just way too high. Buy-sell ratios have come back closer together, so we're not in an extreme range there. We were earlier in the week. We were mildly extreme, but now we're right back close together here. We could be crossing. Although if the selling continues, what will happen is you'll see the sell go right back up again. The buys come back down. You see that happen sometimes where it doesn't quite cross over. You can see back here it did that, where it started to come closer together and then it went right back apart again. And then our other sentiment indicators up off the lows there. So again, it's still kind of in a neutral range right here. It could go either way, but not in any sort of extreme overbought or oversold condition. Let's go to the charts. Now, again, if I were to tell you what is the market mood right now, is the market bullish or is the market bearish? What would you probably tell me based on the last 2 weeks? Well, the market is telling you it's neutral. It doesn't know where it wants to go. Okay, it's reflecting that in the sideways behavior right here. This is indecision. Anytime you see market moving sideways, it means that. So let me put it this way: if you have a stock in your head and you think to yourself, man, I know this stock is going to go up. I know it. And I've been following this stock a long time, and I just know it's going to go up. And you look at the chart, that stock is going sideways for 2 weeks. Then I'm telling you, that's the market is telling you we don't know, or we're not sure, we're not confident. So if you're really confident, you might want to second guess that confidence in the fact that the market itself is saying I'm neutral. I don't know. because that's what the price action is reflecting right here. Sideways price action is reflecting indecision. Okay. Now, what I always tell you though is it doesn't necessarily mean that can't help us know where that stock could be going. Whenever you see a stock moving sideways, yes, it's showing indecision, but you want to pay attention to what was the impulsive move or the confident move that took place before that stock moved sideways. That's where that stock is more likely to go after it's done moving sideways. Obviously, we had in the beginning of January or beginning of December that impulsive move down, sharp move down, indecision. What should follow is another move down. Now, it could just mean that it breaks just below this range and that's it, and then it takes off again. It doesn't mean it has to go a huge distance or anything like that. But it should break to the downside when the sideways move is done. Now we've been talking about this for a few weeks because we're still in the sideways range. Okay. I think though that now we have a pretty established sideways range that we can identify significant areas. Obviously, a breakout above here would be more significant. From the bullish side, a breakdown below this lower part of the range would be a lot more bearish. Although, again, as I talked about on Tuesday, I'm looking at an area here about 389 is the number I told you not to focus just on a number, but 389 kind of reflects this horizontal support resistance. We also have a little bit of support up here. And then obviously we have the top of the sideways range right here. So you can kind of highlight this as a resistance area right here. A lot of resistance here. And if we punch through all that, that would tend to force us to have to look at the market in more of a bullish way, although it wouldn't give me a whole lot of confidence in the way that, usually you get these impulse moves down, corrective, and usually at least another move down. I'd be a little bit suspicious of a breakout there, but you got to follow what the market's doing. And by the way, just because I may turn more bullish with something like that doesn't necessarily mean that I'm going to be aggressive in that direction. Maybe it means I feel bullish enough to go buy a high strength ranked stock or something like that, or a stock in the new buy list or something like that looks really good. Doesn't mean I'm going to go load up and buy, all 10 stocks in my portfolio and use up all the capital in my portfolio because we moved above a bullish area there. So again, keep that in mind as well, is that when I talk bullish or bearish or shifting from bullish to bearish, it just means that there are different decisions you can start to make. It doesn't necessarily mean you'll make bold decisions every time something like that takes place. All right, now another thing I told you to watch, we've been watching for a couple weeks now, is to look at the range of the day before. Do we move outside of the range? This is a real simple price action exercise that you can do to determine whether the market is leaning more bullish or more bearish, or the buyers stronger or weaker. The buyers have been neutral since last Wednesday. Now, last Wednesday was the last time that we closed outside of the range of the day before. It was the range of Tuesday last week. We closed clearly below that. I felt really strongly that was the bears taking control. We were at the bottom of the sideways range. I thought for sure the market was going to sell off. The only thing I hesitated about was that we were in holiday week, going into when everyone's going on vacation. Typically, we don't see big moves around that time. And so it wasn't too shocking that the next day the market actually rallied back up. We've been kind of flat since. It's kind of just that time, the time period, time of year. You could probably chalk that up to that argument. But even though we rallied up that Thursday, we didn't close outside of the range of that Wednesday price action. We closed right at it. We traded above it, but we didn't close outside of it. So we remained neutral. Same thing happened on Friday. We stayed within the range of Thursday. We're neutral. here was the range of Friday. On Monday, we closed. We opened above it, but we closed inside of that range, remained neutral. Actually, this was Tuesday. I said Monday, Tuesday's move. And so Wednesday, again, we were traded completely inside. And then here's yesterday, here's Wednesday. Now we're at the lower part of that range. Now we were below it earlier. And what's going to be important in the next hour or so is to see where we close. Do we close below that range? If we do, it means the bears are showing that they're taking a little bit of control in this market. Now, don't make drastic decisions on that alone. That's just a little bit of a confirming factor. It's a real simple exercise of, bulls and bears. It's like if a football team is at midfield and they get a first down. That's a bullish thing. It's a positive thing that football team got a first down. They get another set of downs. But it doesn't mean that they're now clearly the favorites to win the game, right? Every team gets first downs throughout the game, back and forth. It does not mean that they've won the game, or that alone that means they're going to win the game. But it is a little subtle clue that tells you that they're doing well. They're behaving well at that moment in the game. They got that new first down. They're getting closer to scoring, but they've got that positive momentum. That's all this is saying. So don't look too much into this. Now, this can be a confirmation entry technique that you use too. Let's say you see in this case, let's say this is a bearish looking pattern. You got an impulsive move down, you got a corrective move, and you want to short the stock, or you want to buy a put option, and you want confirmation though that it's more likely to go down. We didn't get that confirmation recently because you haven't closed outside of the range. If you were to finally close below this range today, that might be enough confirmation to go ahead and buy your put option trade. Doesn't mean that trade will still work, but it's a little bit more tilted to your favor now that you get that little bit extra momentum or confirmation from the bears, okay, closing below that range. You'd like to see a real clear close. These ones that close were judgment calls, like we had last Thursday was a judgment call that closed right at the high of that range. That's a little bit more murky, and we'd like to see it real clear. But that's why this one on Wednesday was kind of confusing, because it was a real clear. Not only did it close clearly outside of the range of the day before, but close at the lows of the day, close right at the lows of the range. It just looked like, man, this thing's getting ready to go. And I did a few put option trades when that happened, expecting that we were going to get an immediate drop off of that. All right, so now again, going back to that phrase, whenever you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's likely to go. After it's done moving sideways, who knows? We could be stuck in the sideways range for, sometimes you can be stuck in it for a long time. This is about as long as you'd like to see it. The longer it gets, it tells you just really how indecisive the market is, and you don't often get real explosive moves when it finally breaks out. You like to see a little bit of indecision, but not too much. And so we'll see if we get shaken out of this. By the way, I don't care which way we get shaken out. All I really want as a trader is movement. I can make money if there's movement in the market. I hate sideways moves. It's just, you can still make money with those sideways moves. There are techniques you can use, especially with spread trades and different types of option trades. But I've always found that you end up working twice as hard for half as much money in those conditions. So I'm not a big fan. Now, part of why I talked about some of these events coming up, again, the events themselves, I really could care less In fact, I have to look this stuff up because I don't I don't have them on a calendar or pay much attention to when they happen. Usually I find out like the day before. Oh, Chairman Powell speaking tomorrow. Oh, yeah, the jobs reports tomorrow. That's right. It's not something I obsess about, but these are triggers. These are things that could shake us out of the sideways range, and that's why I felt like pointing those out right at the beginning of class, things that we could kind of pay attention to and look at. All right. So again, not much has changed from Tuesday. We're still expecting this next move down. Let's look at the Dow chart here. The Dow is actually trading currently below the low of yesterday's range, although it's very close. Maybe we'll take a peek at this at the end of the update here, but it is something you'd want to look at too at the end of the day where we at. Now, there's a lot of movement that does happen in the last hour. In fact, you can see it almost every day where the market will be kind of stalled. And then as soon as you get to the top of the hour, the last hour of the trading day, it starts moving. And sometimes it's a false move. It'll start to move the first 15 minutes, and then the last half hour, it'll start taking off the opposite direction. These are the professionals typically closing the market. The professionals tend to close the market. And that's why that's the most important part of my day is I want to see how things are going to close, how they look at the close. By the way, if you're tired of watching your computer screen all day long, and I can't do it. I have to peek in. I just can't sit and watch the screen all day long. So I look at it at different segments throughout the day. But if you're the same way, if you're getting exhausted in the last 2 hours of the trading day, and you can't watch it anymore, and now you're taking your breaks. I need to shift your schedule for you. You want to do the opposite. You want to watch in the first, probably about the first hour of the trading day, maybe hour and a half. But then remember that middle part of the day where the professional traders go to lunch, right around 11 p.m. Eastern time. Don't be doing a lot of getting into new trades around 11 p.m. Eastern time. You can still exit trades and hit target profits and profit target areas and things like that. Exit trades, but don't be getting into new trades because that's typically it's kind of typically the dead period of the market day. And then it starts to pick up, right around really about 2 p.m. Right when I start this class is really when things start to pick back up again. And then really that last hour is when it is definitely you want to be paying attention. You'll make better trading decisions if you can kind of see and watch how things close today. All right, I don't want to focus too much on, again, the NASDAQ 100, just for those who are new, that was significant last week when we closed at a new 52-week low. That was a 52-week closing low. We did open lower on this day in October. We closed up here. So this is significant from the standpoint of is the NASDAQ leading the way? It typically is leading, and so we're wondering if it is ultimately leading the market down. And it does seem like it's doing that, and it also seems like the market's doesn't seem to be paying too much attention to that fact. Russell 2000 is clearly below the range of as of right now, the range of yesterday. So that'll be important to watch. Do we end up closing below that range? That'll be more bearish. This could be wave A, wave B, wave C to start another move down. But sometimes these can be just choppy. They can chop back and forth a little bit before they drop. That's why I told you on Tuesday, it was very difficult to know in the very near term, whether we're going to drop from there or try to rally. I just felt like any attempted rally would probably fail. I still feel that way. If we do have an update, it's probably a failed update. And that would come into play tomorrow. Let's say the market gaps up on a jobs report initially. I wouldn't get too bullish on that. See how it trades after that. Remember, we got that CPI report back here and it gapped up. It looked like a big positive gap up from the market off that CPI report. And then, man, by the end of the day, it was looking very bearish and led to that next decline that took place. So I just don't see. I'd have to see several really strong bullish days in a row for me to believe that the buyers are jumping in and starting to take control. Bonds, this is, I told you on Tuesday, this is a little bit, we had this impulsive long trend down, then we had kind of an impulsive move up, impulsive move down, and this was starting to look impulsive up. But now we're showing a little bit of a pullback right here. We'll see if this starts to look more sideways over the next few days. If that's the case, it could be more bearish for bonds. That maybe this is the impulsive move down, this is corrective, but we might have another move down. The way all of this behavior, though, is really difficult to read as of right now from a chart perspective. It's really hard to get a grasp as to which way the bond market is going. You could make an argument that this is still a higher low if we keep going higher from here, and if we break out above here, that'd be a higher high. And yeah, if that happens, I'd have to recognize that as a bullish trend behavior. But as far as the impulsive corrective type alternating behavior, we're not getting a lot of that here, which is making it a little bit more difficult to read the next direction of that chart. Gold has looked really good. It's pulled back a little bit today, but I like the overall trend of gold. I think it's going to continue to move up. Oil had another big move down, but a lot of oil stocks actually rallied. Some of them rallied today, although we did rally a little bit in oil, but some of those oil stocks rallied pretty strong today. I'm still trying to figure out this chart because, like I said, this looked impulsive, this looked corrective, then it had a deeper retracement up into here, but then it dropped right here. Still trying to figure out if today is just a pause for another move down. The bottom line is that, now you got the lower high, lower low. This was the last lower high before that last lower low right here. So this is a key area. If we break above that, that's a significant higher low. You say, well, what if it rallies from here and breaks above here? Would that be a higher high? Well, it would be a higher high, but it wouldn't be coming from a previous lower low. So that's what I'm saying. This low and that previous high becomes significant. You could have, especially if it holds right here, you have an even low, didn't go to a lower low, and then it goes to a higher high. I mean, that could be a little bit more bullish if it behaves that way. But the bottom line, the way it's acting, it's still acting more bearish. It's still within this downtrend. And so I'm still leaning a little bit more towards being bearish on oil, but I don't have a strong directional outlook for that right now, the way it's kind of whipsawed a little bit back and forth. The dollar had a big move up today. Again, I talked about this on Tuesday that we're looking at this as whether is this just a corrective move, kind of a bearish ABC pattern, and we'll continue to move lower. If it really starts taking off and looks more impulsive, then we might have to look at the possibility of a trend reversal. But I don't see anything in the movement over the last few days that would indicate a trend reversal yet. It could just be a correction within the downtrend. Could be a reason why the market's down a little bit today too, as well. The market's had a tendency to tend to drop when the dollars have been rallying, kind of have that inverse relationship. Not always, it doesn't always have that relationship, but it's tended to have that over the last couple months. The VIX is up today, but it's still, again, relatively low. Now, one thing to keep an eye on, one thing to read when you're looking at the VIX as well is when you get a big move up in the VIX, when volatility increases, one of the things that is telling you is it's telling you that the movement of the market should start to increase. In other words, we've been seeing the Dow, and you're not comparing it to the Dow. It's always compared to the S&P, but people are a little bit more familiar with Dow points sometimes. They tend to read that more often. So let's say right down in here, the Dow's been moving up or down 200 points roughly a day, up or down. Right now we're up or we're down almost 300 points, I think. What are we at? I don't see it. Let me see it right here. Hold on. Here it is. Down 267. So if the VIX were to spike up into here, it gets up in this 27, 28 area, one of the things that tells you is you should start to see bigger moves in the market. You might see the Dow down 600 points or 700 points, probably closer to that, 800 points or something like that. Let's say 800 points. Or now the spike in the VIX, all that's saying is you should see increased movement. That could be up or down, but you could see both. You could see what happens is the market starts swinging more wildly. We have a big down 800 point day, and then the next day the market rallies up 400 points, and then you get 1,000 point drop, and then in other words, you're getting these wild fluctuations. Anytime you see the market moving faster, back and forth, up or down, it's typically a bearish sign. So if the Dow drops 800 points and then another 200 points, and then the next day it's up 900 points, don't look at that up 900 points day as a sign that the market is bullish. That volatility, that big swing back and forth is a very bearish signal in the market. It usually means the market is acting like it wants to go lower. And so what often can happen here when we've had relatively low volatility here for a little while, and I know we got the drop back in the first part of December, but ever since then we've been kind of flat, is that we'll probably get a day where it shocks, where it spikes up, we'll see a big down day in the market. And what you got to be very careful of when that happens is that is not the end of the selling. If you look at that as, boy, this is a buying opportunity, this is the market bottoming right here. There's a lot of these stocks now. I can't believe how far Apple has come down now. I'm going to jump in and grab it here. That probably means it's just the start of the decline. Now, again, and the decline doesn't mean it's got to go straight down. You're going to have back and forth. You don't go just straight down, but keep that in mind that if we had a sharp move down and that VIX spikes up, it probably just means, hey, we're just getting started. And at that point, I probably would be looking at this as being support. I'd be looking at the volatility increasing. And what could happen is you get another down move, and then you get a big move up that looks like, oh, we're bouncing off that support. Then this is a big upward day, a 3% move in the S&P. It probably means it's coming right back down in even a bigger way because that volatility is increasing. When you know you're in a really healthy bullish trend is when you're getting up days, but they're not big up days, and they're just steady up days. It's like you're up almost every day, but the Dow's up 50 points, the Dow's up 75 points or 100 points, but it's not real big, but it's just steady. That it's calm, and usually that's when the VIX comes way low, and it's telling you it starts to come down, and it's telling you that it's just kind of you're in kind of just a steady bull. Now you see this typically more in bull markets. You're not going to see it in this type of bear market right now, at least not for a while, where you get that real steady move. But that's often a signal. Just if you kind of equate that in your head, that small and steady is bullish, and wild and whipsaw is bearish. That's a good thing to have as far as in your head to as far as analyzing the stuff. Okay. So again, bottom line, what are we looking at? We're still looking at an indecisive market leaning more towards the bearish side. So I'd want to be very cautious. Wouldn't want to be jumping into too many new positions here. Cash is probably the safest place to be. We talked on Tuesday that some of those inverse ETFs you could consider in case the market goes lower. And you want to stay in stocks that are they're still trending up despite the market going down. As far as ideas, I keep coming back to the aerospace sector. It's right near the top of the list. Northrop Grumman is one of them, one of my favorites in this list. They are, from a fundamental standpoint, and again, I'm not a fundamental trader, but, it's pretty obvious they have orders that they're not going to be able to fill for years on all the weapons that everyone wants to buy right now because of Russia invading Ukraine. And 93 strength rank. I like we had a little bit of a V-shaped move. The market has been moving sideways. This has been kind of consolidating sideways. It could go lower if the market sells off, and so I'm not suggesting you jump in here. But what you could do on this one right here is just draw a trend line across here. If the market is going to sell off in the near term, then just keep this in a watch. Just keep an eye on it. If it can get back up and break out of this area right here, that'd be a great place to buy. And the reason for that is you can usually on these type of chart patterns, what you can do, especially when you have a well-established resistance area like this and a big deep bottom down here, is you can take the distance of the top of that range to the bottom of the range, and when it breaks out, you can project that same distance upward, and it gives you kind of a minimum target or expectation of where that stock could get to. Now, typically, this type of measurement is going to work better in a bull market. Okay, that's common sense. If the majority of stocks are moving up, then there's a better chance if this one breaks out that it could continue to move up, and it could move up into that target range. Okay, but a lot of potential there for it to get back to that area. I also like Raytheon. Here it's under the buy section here under aerospace, under the buys. I could switch this over to signals here. Now it's an 89 strength rank, a little bit on the lower end of the strength rank, but still a pretty high strength rank. Kind of the same thing. It's been kind of consolidating into here. It can break out. It's a higher low, kind of an even high right here. You got kind of an ascending triangle pattern. That's why I'm probably waiting for it to break out above here. By the way, with the ascending triangle pattern, same thing. You get the breakout. You can take the base of the triangle right here and project that distance from the breakout. It gives you a minimum target area you could expect that stock to go to. And then there's one under the sell section here, Lockheed Martin. Although it has a sell signal, the overall pattern is still consolidating, just like the other ones. So I wouldn't be panicking the fact that it's still, because I'm not saying go buy into it right now. By the time this thing were to break out above here, it probably would have a buy signal, but you can see it's just been consolidating through here. I don't know how long it could do that. I don't know how far it could pull back if the market sells off, but this is an area that gets above this area on all three of these stocks. And I'm not saying buy all three. I'm just saying that's the area where I would start to look to add some of these these companies. And this is a sector that it's a sector that should do well no matter what the economy does, because these countries are buying weapons. They're printing their money to buy the weapons if they have to, but they're buying the weapons. It doesn't matter if we go into recession or not; they're going to be buying those. So the only question would be is how well is Northrop Grumman, Lockheed Martin, and some of these others, how well is their management team managing expenses and all that other stuff you manage as a business, inventory and all that, and are they executing? Which typically they are. There's usually some pretty good CEOs running those companies. All right, oil remains at the top. This has been energy. Oil has been at the top of the list here. Now I just showed you the chart of oil where it's still a little mixed as to which direction it can go in. There are a couple of decent charts though on here. I do like where is it? Here it is. Halliburton. And again, what I like about this is you've got a little bit of an inverse head and shoulders pattern. Again, a nice breakout area here. If it breaks out, you take the top of the range to the bottom of the range, project that distance upward. It's a very bullish type pattern. Now, again, could it be that if this is the left shoulder, this is the head, could the right shoulder right here dip down a little bit further down into here before breaking out? Yeah, it could, and that would account for the market sells off here and it comes down to that. We look to see if it holds this level in here, but definitely if it can break out above here, that'd be a nice entry point on Halliburton. 96 strength rank. And then also where is it? For some reason I'm having trouble finding. I was looking under. I think I was looking under the holds. Let's see here. There it is. Transocean rig. That's weird. I hit 94 strength rank. You got just basic, again, higher highs, higher lows. This recent pullback right here looks like it put in a higher low, back to a buy signal day. Nice, strong, bullish move. Is it going to continue to go higher from there? Good. And some of these, if you can just give them wide stops. You can put a stop down here and say, okay, if there's a market sell-off, hopefully it doesn't come all the way down here and stop me out. Or on a stock like this, it's only a $4 stock. If you just put a small amount of capital in it and not use a stop, be willing to risk. This company is not likely to go out of business. It's had some rough times. It's gotten down to a $2 stock before, but as long as energy keeps growing and energy needs keep increasing, the stock will tend to do pretty well. But that chart looked pretty good as well. Another sector I liked a few stocks in was under basic materials. This is also where I found some of those gold stocks and the gold mining ETF that I told you about recently. That I like some of those plays. Today I'm going to talk about tech resources right here. 90 strength rank. Nice little bullish day today after a little bit of a pullback here. Now, I'm a little concerned that on this pullback, we did dip a little bit below the support area. We'll see if that becomes a problem later on. But nice bullish day so far today. Let's see if that can continue to move higher. But this one's outperformed. With the market going lower, this one keeps going higher. Could be a little bit of choppiness in there, as we've seen with a lot of these that you'd have to kind of endure, but that one I like. And again, I need to emphasize, I'm going over several different ones here. I'm not suggesting you go into all these or anything like that. I'm just pointing out some stocks that are looking pretty decent in these conditions. But I'm gonna warn that I think we got a big drop coming here in the next week or two, and really wouldn't be loading up on too much ahead of that, because I think you'll get better prices on a lot of this stuff after that market sells off. So another one under basic materials is this Model A, 90 strength rank. A little bit of a consolidation into here. Managed to keep a higher low right there. Here's kind of a breakout area. This looks like a little bit more of a consolidation. Previous move was up. Should continue to move up. If it does break down below this area, that would be more bearish, and that could be a place for a stop if you're looking to get into something like this and manage it in case it does sell off. But I like this chart, and this ties into the recent, there's a lot of infrastructure stuff in that last bill from Congress, and there's a lot of companies that are involved in infrastructure that will benefit from that. And we've seen that, ever since that bill came out, we've seen the stock steadily stair-stepping its way up. So this one's looking like it's outperforming the rest of the market as well. All right, real quick before I wrap things up, there is a couple things that are part of the software that I want to point out. I got a question during the week on this. Hold on a second here. I got a question during the week on this, and this is actually a rare thing that happens. There's a couple of these I thought I'd point out. I point it out from time to time, but then I get new people in, and they're I guess you can call them little glitches, but they're glitches that really can't be corrected based off of what the data that we're given. We have to be made aware of them, and then Jesse can go in and fix the algorithm related to that. But like I said, they're unique situations. One of them that I can understand why I got the question on it was this one at the top of the new buy list, this HIPO, Hippo Holdings right here. Now, obviously the stock was moving kind of flat through here. It suddenly had this huge move up, went from 70 cents up to $15, and it's been in this high range for the last couple months, last 3 months or so. Well, under normal circumstances, okay, a move like that, a lot of times a move like that would be related to a company that maybe a drug company that just had their drug okayed, and suddenly the value of that company just spiked up. it has a 100 strength rank, which means it's outperforming. It's in the 100 percentile of all other stocks out with there. In other words, this stock is outperformed. It's at the top of the list of stocks that have outperformed all the other stocks out there. Not the stock that's outperformed, but it's in that 100% percentile. The problem is that gap up was not created by a increased demand for the stock. It wasn't based off of some new product or new idea or something that got traders excited and willing to buy it up that far. This was a unique situation because if you go back and you looked at, if I looked at this on my other charting service, I had to go back and look at it on my other charting service. This is what the stock looks like when it's been combined. Well, when it's combined the event that took place. I'll explain the event. Because the question I got was, wait a second, how could this be a 100 strength rank in the 100 percentile of all stocks out there? And look at what it's done over the last 2 years. It's gone straight down. Well, the answer, and again, this is very rare, but it's a unique situation, and I want to teach it to you in case you see it again, you'll understand. Anytime you see a big jump like that and you're looking to get into a stock like that, do some research on what caused the jump or what was the jump. Always do that because there's a lot of unique things that can happen in the stock market. Don't happen very often, but they can be unique, and they might be reasons not to trust what you're seeing there, and this would be one of those cases. What happened back here at the end of September is that HIPPO had a reverse stock split. Now, typically we're used to regular stock splits. You know, there's you have 100 shares of a stock that is $200 a share. It does a 2-for-1 stock split, so it's going to give you 2 shares for every one that you have. But what's going to happen is that now what's going to happen is you're going to have 200 shares, but the stock price is going to split in half. It's going to split. That'd be a 2-for-1 stock split. So it's going to be, you're going to have 200 shares of a $100 stock, right? Now, your position value has not changed. It is still worth exactly the same. Instead of 100 shares of a $200 stock, you have 200 shares of a $100 stock. Now, why do companies do this? Well, they do this to bring the price down so that maybe it's attractive to other traders. Tesla did this recently. It was a $1,000 stock. It did a 7-for-1 stock split. It brought it back down to where the average person could afford to buy it. Apple did the same thing. Google, Amazon did the same thing. Amazon was a $2,000 stock. The average person couldn't buy, the shares of that stock. It did a big stock split, and now it's, I don't know what, or 80 something dollars a share or something like that. Okay. This is the opposite of what happened here. Sometimes when stocks are they have a lot of shares, tons of these shares out there, and yet the price of the stock is really low. Let's say it's a $1 stock, and someone's got, 1,000 shares of that $1 stock or something like that. They'll do a reverse stock split. So in this case, for every 25 shares that you had, you're going to be issued 1 share. And you say, well, that's a bummer. Well, not necessarily, because what's going to happen then is that it's going to reduce the amount of shares out there, the float. There's too many shares out there. And that's why the price is having a hard time moving. And so now you get and that's the way you never do math in a class, especially when you're not a math person. So basically what you would have there, would that be 250 shares of a $10 stock or something like that. Did I do that right? I don't even know if I did that right. But anyway, now the stock price is boosted up, and you have fewer shares. The value is still the same. That's not the same value there, so I did it wrong. But the value is still the same. But now what happens is now you're not this penny stock anymore. It's more of an attractive stock. GE did this a while back. It was stuck at like a $3 or $4 stock, and it just couldn't get going. It got kicked out of the Dow Industrial Average, and so they did a reverse stock split. It's a number of years ago, but see now it's a $60, $70 stock. But they took out a whole bunch of the shares out of the float. So that's what happened here. And you can see it on the now. What happened on TradingView here is it blended it made the calculation to blend shares in. Okay, and we can do that on TradersPro as well, but it doesn't automatically do it. It doesn't recognize it till it's pointed out. We find it, either we find it or somebody tells us, "Hey, this is weird." And then we find it. I'm sure I'll tell Jesse about this, and I'm sure they'll make the adjustment on it. But you can see it on TradersPro, because you can see exactly what happened. That's how the stock that was a 70-cent stock suddenly became a $14 stock. There was a reverse stock split. Okay. So no, this wasn't a big gap up and the stock is taking off. The stock is actually still just kind of hovering and not doing great. But because it made that big jump like that, the algorithm that calculates the strength rank immediately assumed that was strength. Okay. Like I said, this doesn't happen very often. In fact, I had to do the research on it to figure out what happened here. But that's what happened. And it's very rare, but that's why I say anytime you see a big gap, go do a little research and find out why it gaps. And if you have any other questions aside from that too that you may not understand, go ahead and send them to me. I can probably help you with that, try to figure out if there's something weird going on there or not. By the way, these are normal glitches that happen with any software program. VectorVest, whatever other software. There's all these different types of signal software out there. They all run into the same issues with it, and they're very rare, like I said. Another issue that you'll see sometimes, and this is probably more common that you'll see it, if you go into, I think we can find it here on the new buy list. Maybe it's not on the new buy list. I see it on the, might have been the biotech or the healthcare one, because sometimes you'll see this a lot on medical stocks. Anyway, I can't remember where I saw it. I'm going to type it in. It's IMGO. Yeah, it was a bio. I must have seen it in the biotech stock. Okay, whenever you see this, stock was trading right here. It gapped all the way up to here, and then it's just going flat line. Anytime you see a big gap up and then a flat line, I mean, just flat, not this, not up and down, but just flat. This is an indication of a buyout, meaning that some other company bought this company out, and we know what price they bought them out at. They bought them out at about $36. So they're doing a share, they're buying the shares of the company to buy them out, okay? That stock will jump to that price because it's a premium. And usually that's how they get people to sell them the shares. The stock was trading down here. They think it's really valued or it's going to be very valuable. They come to their shareholders and say, hey, your stock is worth $18 right now. We're willing to buy it from you right now for $36. And they're like, here you go. I don't have to wait for that move. I get that move immediately. They want the shares because they want to own the company, the controlling interest of the company. So it gaps up. Now, the problem is it's not going to go anywhere beyond that. Why? Unless somebody else comes in and says, oh, well, we're willing to buy it for $43, then it could go up. But typically on that big of a move, nobody else is going to be coming in, and that stock's not going to go anywhere. So if you're looking at this stock and saying, oh, man, this stock made this big move up, it's a 95 strength range, oh, man, I'm going to jump in this thing. Well, yeah, you go ahead and jump in it, but you're not going to go anywhere. You're going to be dead money. And now, eventually, the shares will merge into the new company. It'll become part of the new company, and maybe you'll get some, as part of that, you'll get some shares of the new company in some split agreement somehow or whatever. And if you wanted to own that other company, that's great. You could do it. You'll now own part of that other company. But as far as trading, no, you don't want to be messing around with that. Again, I wish we could eliminate that in the software. It's just there's just not a way to eliminate that because they're still trading. They're still trading. It's just there's really very little volume being traded because it's stuck right. It's going to be stuck at that price. It's not going to go anywhere unless the deal breaks down. Sometimes the deal will break down and it'll start jumping right back down again. But the big way to notice that is an unusual gap and then a flat line. You see it just moving completely sideways, no fluctuation. That's a buyout. Okay. All right. So those are just two unique areas there. Hopefully that answers some questions that maybe some of you bumped into or ran across. And like I said, both of these are pretty rare. Although you will see it in certain sectors, like I said, you see this a lot in the biotech sector just because there's a lot of these small biotech companies that they're startups. They come across a drug, and then a bigger company buys them out. So you'll tend to see that a little bit more often in those sectors. All right, that's all I have. Have a great weekend, everyone. Oh, real quickly here, like I said I'd take a look at the SPY. Yeah, we come up a little bit further, so we're still within that range. We may not. It may just be that we'll get the break tomorrow off of the jobs report. Maybe the market just wait for that jobs report tomorrow. And now that could change. We still have an hour to go, but it's looking like we might close within that range. Let me look at the IWM because that was the one that was outside of its range. Yeah, no, but it's right back in that range. Okay, we'll see how we close. All right, thanks, everyone. Have a good weekend. We'll see you. We'll be on a normal week next week, finally. We have a Monday next week for once in 2 weeks. And then we'll see on Tuesday for the market update class. Have a good weekend, everyone. Bye now.